You pull up a stock chart for the first time, and it looks like a chaotic mess of colorful lines, strange shaped bars, and confusing abbreviations. It feels like you need a secret decoder ring just to understand the basics. But what if I told you that learning to read these charts is simpler than it looks, and it's the single biggest advantage you can give yourself as a new investor? A stock chart isn't just a picture of past prices, it's a story. It's a visual narrative of the battle between fear and greed, between buyers and sellers. And learning to read that story allows you to make decisions based on evidence rather than emotion or guesswork. This video is your absolute beginner's guide to reading stock charts. We're going to break down every single element you see on the screen, from the basic candlesticks to the key indicators that professionals use. By the end of this, you won't see a confusing jumble of lines. You'll see a clear picture of a stock's trend, its momentum, and the levels that matter most. Let's start with the very foundation of any chart, the price data itself. Most modern charts use what are called Japanese candlesticks, and they are incredibly informative once you know how to read them. Each candlestick represents the trading action for a specific period, whether that's 1 minute, 1 day, or 1 week. The main body of the candlestick shows you the opening and closing prices for that period. If the close is higher than the open, the body is typically green or white, indicating a price increase. If the close is lower than the open, the body is red or black, showing a price decrease. But here's the real insight: the thin lines above and below the body, called wicks or shadows, show you the full range of prices for that period. The top of the upper wick is the high, and the bottom of the lower wick is the low. So, in a single glance, a candlestick tells you for critical pieces of information: the open, high, low, and close. A long green body with small wicks tells a story of strong buying pressure throughout the period. A long red body shows strong selling pressure. A candlestick with a small body and long wicks, on the other hand, indicates indecision and a battle between buyers and sellers. Now, step back from the individual candlesticks and look at the overall shape they create. This is where you identify the trend, which is the most important concept in chart reading. An uptrend is defined by a series of higher highs and higher lows. It's like a staircase moving upward. A downtrend is the opposite, a series of lower highs and lower lows, like a staircase going down. And sometimes, a stock is in a consolidation or ranging phase, where it moves sideways between two key price levels. Identifying the trend is your first and most crucial job. As the old saying goes, the trend is your friend. Trading with the trend, buying during uptrend pullbacks and selling or avoiding during downtrends, dramatically increases your odds of success. Fighting against a strong trend is a beginner's mistake that can be very costly. The trend gives you context for everything else you see on the chart. Once you've identified the trend, the next key elements to spot are support and resistance levels. These are the foundational concepts of supply and demand drawn on a chart. A support level is a price zone where buying interest is consistently strong enough to overcome selling pressure, causing the price to stop falling and bounce back up. You can spot it as a horizontal line connecting several important lows. Think of it as a floor under the stock's price. Resistance is the exact opposite. It's a price zone where selling pressure overcomes buying pressure, stopping a rally and pushing the price back down. It acts like a ceiling. These levels are crucial because they give you logical places to enter and exit trades. For example, a beginner might look to buy a stock when it pulls back to a key support level in an established uptrend. Conversely, a break below a major support level can be a warning sign that the trend is reversing, while a break above resistance can signal the start of a new powerful uptrend. Now, let's talk about the other critical component sitting at the bottom of most charts: volume. Volume is simply the number of shares traded during a given period, and it's the fuel that drives the price movement. Think of it this way: price is what is happening, and volume is how much force is behind the move. A price increase on high volume is a much stronger, more legitimate signal than a price increase on low volume. It shows broad participation and conviction. Conversely, if a stock is falling on high volume, it shows strong selling conviction. Low volume during a price move suggests a lack of interest and that the move might not be sustainable. One of the most powerful signals in chart reading is a volume climax, where a huge spike in volume occurs at a key support or resistance level, often confirming a breakout or a breakdown. Finally, we have technical indicators, which are mathematical calculations based on price and volume that are plotted on the chart to give you additional insights. It's easy to get overwhelmed here, so as a beginner, I recommend you focus on just one or two. The moving average is the simplest and most effective. It smooths out price data to create a single flowing line that helps you clearly see the trend. The 50-day and 200-day moving averages are the most widely watched, when the price is above its 200-day moving average. The stock is generally considered to be in a long-term uptrend. Another popular indicator is the Relative Strength Index, or RSI, which measures the speed and change of price movements. It oscillates between 0 and 100 and is used to identify potentially overbought or oversold conditions. An RSI above 70 might suggest a stock is overbought and due for pullback, while an RSI below 30 might suggest it's oversold and could bounce. The key with all indicators is to use them as tools for confirmation, not as crystal balls. They work best when they confirm what the price action and volume are already telling you. Remember, this is educational content, and past performance is never a guarantee of future results. All trading and investing involve risk, including the potential loss of principal. Please do your own research and consider your risk tolerance carefully. If this guide helped you decode the language of stock charts, please hit that like button and subscribe for more tutorials that build your financial confidence. Now I want to hear from you. What S1 chart pattern or indicator you've heard of but never quite understood? Let me know in the comments below.